Central banks. They sound boring, right? Like a bunch of stuffy old guys in suits whispering about numbers. But hold on a second. These folks have a huge impact on our lives. Think of them as the referees of the economy. Their main job? Keeping things stable. They don't want prices going haywire, making your morning coffee cost $20. They also don't want everyone out of work and the economy in the dumps. It's all about balance, baby. So how do they do it? With something called monetary policy. It's basically a fancy way of saying they control how much money is sloshing around in the economy. Too much cash and things get crazy expensive. Too little, and businesses can't grow, and people lose jobs. Central banks are like the economy's personal trainers. They're constantly making adjustments to keep everything in tip-top shape. And trust me, we're all better off when they're doing their jobs right. Now let's talk tools. Central banks have a few tricks up their sleeves to keep the economy humming along. Think of them like the economic versions of Batman's utility belt. First up, we've got interest rates. This is the price banks pay to borrow money. Lower rates mean cheaper loans for businesses and consumers. More spending, more growth. But raise those rates, and things can slow down. Next, we have open market operations. Sounds complicated, but it's just the central bank buying or selling government bonds. Buy bonds and they pump money into the system. Sell bonds and they suck some out. It's all about managing that money supply, folks. Last but not least, there are reserve requirements. This is the amount of cash banks need to keep on hand. Lower requirements mean banks can lend out more money, boosting the economy, but raise them too high and things can grind to a halt. So how do these tools actually affect the economy? Let's break it down. First, inflation. Remember that crazy coffee price? Central banks use their tools to keep inflation in check. Too much money floating around makes prices go up, so they might raise interest rates or sell bonds to cool things down. Next, employment. Nobody wants to be out of a job. Central banks get that. When unemployment is high, they can lower interest rates to encourage businesses to borrow, expand, and hire more people. Finally, economic growth. We all want a thriving economy. Central banks can use their tools to stimulate growth when things are sluggish. Lowering interest rates or buying bonds can give the economy a much-needed boost. It's a delicate balancing act, folks. Central banks are constantly monitoring the economy and adjusting their policies to keep everything running smoothly. Let's take a trip down memory lane, shall we? Remember the 2008 financial crisis? Yeah, not great. But the Federal Reserve, America's central bank, stepped in with some serious monetary policy moves. They slashed interest rates to near zero and pumped trillions of dollars into the economy. Was it a perfect solution? Nope. But it helped prevent a total economic meltdown. On the flip side, when inflation started soaring in 2022, central banks around the world started raising interest rates. The goal? To slow down spending and get those price increases under control. These are just a couple of examples of how central banks use monetary policy to steer the economic ship. It's a constant process of adjustment and fine-tuning. So the next time you hear about central banks, don't just tune it out. These folks are playing a vital role in keeping our economies afloat. They might not wear capes, but they're kind of like the superheroes of the financial world. And that's something worth paying attention to.